How can you win at the credit game, and should you even try? We'll discuss it with a first-time guest, the guy who wrote the book on it, starting right now.
This is Debt Free in 30. Here's your host, Doug Hoyes.
Let's get started. Who are you and what do you do?
It's a very deep question.
Deep. So we start with the hard questions.
Very, very deep. So business-wise, I'm like the Bill Nye of Credit.
The Bill Nye of Credit. Richard Moxley, the Bill Nye of Credit.
And if you don't know who Bill Nye is, then I just am really passionate about credit and playing the credit game to win.
So why do you call it the credit game?
Because just like any game, there's rules, there's strategies, and it really sucks if you don't know those going in and trying to play a game that you have no clue what's going on. But if you know what you're doing and you know how it all works, then it can be fun.
And so the name of the book you've written is called The Credit Game. Yep. So rules every Canadian must know to win.
Yes.
So in terms of background, how did you get into this?
Well, I always wanted to be a credit.
Always wanted to be a credit guy. Yeah. Growing up, everyone else was playing hockey. I was reading credit reports. Yeah.
Yes. So cool. But no, I kind of fell into the mortgage industry. My brother had got into it, and I thought that was interesting. And so I thought, well, I'll take the course and get started. That was back in 2006, and then ever since then, I was doing I guess for about 8 years, I did the mortgage financing, and that was really good, except for one of the things that I noticed very quickly is how little they teach you about credit reports, but then, of course, the main aspect of what we're doing, one of the main pillars of getting approved for best rates and terms, relies on having a good credit score.
Yeah, and so if you're helping people get mortgages, you're looking at credit reports all the time.
Exactly.
And you're looking at them going, well, if you did these two things differently, then all of a sudden in Spain, instead of spending 5% interest, you'd be getting a 4.5%, 3% interest or whatever. So
yeah.
It has a massive impact not doing
Huge
it correctly.
Huge impact, because people can have great jobs and they can have down payment, but without the credit as a pillar, essentially the bank saying, sorry, we don't trust you.
Yeah, and I mean, viewers of this show or people who've listened to this podcast will know I am not a fan of the credit system, the credit scoring system. Yeah. I don't know if you're a fanboy or not. You're not a fanboy either. There you go. And I mean, I wrote a book too, Straight Talk on Your Money, and I've got chapters in there that basically say a credit report exists for the lender, not for you.
Right.
It's not for your benefit. Yeah. And we all think, if I can, this is a proof of my self-worth, that I have a credit score that starts with a 7 or an 8. That means I'm a good person. No, it just means that you are even better for them to lend to, right, is what it really means. So I agree with you. Looking at it as a game kind of puts it in proper perspective. This is not your life. No. This is not your self-worth. This doesn't say if you're a good person or not. It doesn't even say if you're good with money. Yeah. All it says is you've learned to play the game.
You can suck at hockey, but still have a great life. Not in Canada.
Not in Canada, Ken. That's heresy what you're saying there. But yes, I totally agree with you. I mean, I assume, I've never met him, but Warren Buffett, you probably know him. You probably hang out with him. He's got
my dad.
Yeah, there you go. He's got billions and billions of dollars.
Yeah.
He probably doesn't have a very good credit score because he probably hasn't borrowed any money in 50 years. I mean, he's borrowed money for his businesses, right, but if you got $50 billion in the bank, who cares what your credit score is? And exactly. I think having money in the bank is much more important than focusing on a credit score. Yeah. But if I want to buy a house or I want to finance a car, even if I want to get an apartment,
rent
an apartment, car insurance, maybe even a cell phone, right, a job. These are things where someone may look at your credit score, and your credit report. So first of all, a technical question: what is the difference between a credit report and a credit score?
So credit score is just a 3-digit number that's a summary of everything that's going on your report. So people are generally obsessed with the score, which is one of the no-nos of credit. I have 5 kids, so if you
5 kids,
if you hear a no,
my goodness,
that happens.
There's ways to we can talk about that later. So. Okay, so I get that. The credit report is a list of all the stuff that's related to my credit. Here's all the people I owe money to, where I work, where I live, all that kind of stuff. The credit score is distilling that into a 3-digit number. Mm-hmm. That 3-digit number, though, when I go to the bank may not mean anything because there's a whole bunch of different 3-digit numbers. The credit score that I got when I looked at my report may not be the credit score that the bank uses. Is that true? And if so, why?
Well, I don't know the why, but I'll explain how that works. Is Equifax and TransUnion have been around for a while.
And those are the two credit reporting agencies in Canada.
Yeah, and anything with Experian, that's American. So if you're in Canada, focus with Equifax.
Don't worry about Experian.
Don't worry Experian. So they each have multiple scores that they've had since the 1980s. So with changes that have happened over the years, they come up with a new score. So this credit score, or this assumption that you have just one score out there that is that magical number that everyone's looking at, to be honest, no one's looking at the score that you see as the consumer. Banks and lenders use their own score. And so that's what the main focus of the book is about. And one of the reasons why I actually even stopped on the mortgage side of things to focus on credit, because just everyone's talking about the score and obsessing about the score, when in reality, it has nothing to do whether you're going to get approved. I mean, it's that score that you see is not what the banks are using.
And in a lot of cases, it's because the bank has their own computer. They value this higher than that. They look at, other factors, whatever. And that's why if I get my credit score from Equifax and TransUnion, it's almost never exactly the same.
That's right. Different company and different scoring systems.
So focusing on the score, which is not the score that the lender is going to be looking at anyways, is kind of missing the point then. So, okay, let's talk about the things that impact my score. And so in your book, The Credit Game, you go through a lot of this. And so, people can look it up. So creditgame.net, is that your website? Right. So that's where people can track all this down. You say that late payments lower your score. Okay, that kind of makes sense to me because that's one of the factors. So now you actually talk about a system to make sure that you're never late. So most people, it's like, well, okay, my payment's due on the 21st. I guess I better make sure I pay it on the 21st. Yeah. But as I know in my business, that's a problem because I get paid every 2 weeks. And next month, I get paid on the 24th. And so I won't have the money on the 21st. And now I'm going to be 3 days late, and that's going to affect my credit score. So what is your advice to make sure you're never late?
Yeah, one of the things that I've noticed is that Canadians are really good at paying mortgages, paying loans, but they really suck at credit cards and lines of credit. Well, actually, lines of credit are fine because generally speaking, it comes directly out of your bank account. And so that's the problem, is that it's not that they don't have the $30 or the $100 to make the minimum payment. The problem is that they are just busy. We're just busy doing other things, and we may have the intention to pay it off in full the next week, but if you've passed your due date, now all of a sudden it's late.
And part of that is a timing thing. So you're absolutely right with mortgages and car loans. People, and we're recording this in my Toronto office, and I'll be meeting with a bunch of people after we record this, and they will come in and they'll tell me, oh yeah, I'm up to date with my car loan. Yeah. Well, why is that? Well, my car loan comes out bi-weekly. I've got it matched with my paycheck, so my pay goes in, it comes out, it's all good. Right. Same with my mortgage, I've got it matched to my paycheck. But my credit card is not matched to my paycheck. My cell phone bill is not matched to my paycheck because it's one day a month, and that's not the same day I get paid. So how do I not be late?
So the key, or one of the things that I've noticed really helps people, is automating that minimum payment amount. So on a cell phone, you can actually have it set up so that it is on a credit card, so that it just takes out whatever that amount is. But on a credit card, it's very helpful to look at, okay, so what is my minimum payment if I max it out, or what I typically use, and whether it's 30 or 50 or whatever it is, then go into your bank and have that payment automatically transferred right away.
Gotcha. So my balance this month is $500. I'm going to pay it off all this month because I don't want to carry a balance. Right. But the minimum payment, I know it's always due on the 21st of the month, and it's $50. So I just automatically set up a payment either from my from my bank, an automatic transfer on the 20th of every month, one day early. It automatically sends the minimum payment. So if I forget to make the payment, well, it doesn't matter. I've made the minimum payment. 3 days later, I can pay the balance off, and that's not going to hurt my credit score.
That's right.
Because I wasn't late.
Exactly.
And being late with a cell phone, this was another interesting part from your book here.
Yeah.
So having a cell phone and paying it on time is not going to increase my credit score.
No.
Because it's not credit. I didn't borrow the money.
So it does affect the score, but the biggest problem with cell phones is the fact that people treat them like credit cards, where I'll just throw $50 on there, even though my bill is $100, and that's good enough because I've made a payment. Or I'll call the cell phone company and I'll say, well, I can't make the payment. My commission is coming in the next 2 weeks, and I'll pay it everything. And the cell phone company will say, yeah, no, that's great. We'll just keep things running and just pay us off after. The problem is that even if you're $1 short, if you don't make the full amount, that's a late payment, regardless of what they're saying on the phone.
For being $1 late. So I'm not going to build my credit score by having a cell phone, but I can sure hurt it by being a day late. So again, exactly the same strategy. What day is my cell phone bill due? Make sure I've got it pre-programmed. And if it's roughly $100 every month, okay, well, either send $50 every paycheck because I get paid bi-weekly, $25 a week or whatever, and then I'll eventually be paying a little bit more when I hit my extra paychecks, or know when the date is, make sure I'm sending it. And unlike a credit card, it's not just the minimum balance, you want to pay the whole thing.
100% or you're in trouble.
Now, let's talk about another thing, which I also found interesting in your book, and that is the concept of loan to value. Okay, well, we understand what that means, the loan to, maybe not loan to value, but loan to the authorized credit limit.
Right.
So if I have a $10,000 limit on my credit card, because I'm Warren Buffett, I guess, I don't know, and I'm carrying a balance of $1,000, that's a 10% utilization.
That's right.
And that's not going to hurt my credit score. In fact, maybe it even helps it a little bit. We don't know what the secret algorithm is, but that's not a big deal, I assume. But my balance fluctuates throughout the month. And so I use one of my credit cards entirely for business. So we put through, we had to order all the paper for the photocopier for the whole firm kind of thing.
And the mugs.
And the mugs, absolutely. These went, of course, on a credit card. And I pay it off in full every month.
Right.
But if in my example, my authorized limit is, $10,000, well, I may actually hit the $10,000 a few times a month because I'm buying all these supplies for the business. What impact does that have on my credit score?
So that is one of the biggest issues or errors that people with good credit assume that they're doing okay because they're paying it off in full. The problem is that you should never go over half of whatever the limit is.
Never go over half of what your limit is. And you're not talking about at the end of the month. No. You're talking about ever.
That's right. And if you do, because you are getting a trip or, expenses with your business or whatever it is, just the sooner you pay it off, the better. Because Equifax and TransUnion, they don't have live access or live feed into the individual credit cards or credit accounts. The individual banks and lenders submit information to Equifax and TransUnion every 30 to 90 days. So whenever that snapshot happens, that's what you're being judged on.
That's a key point then. Yeah. Whenever that snapshot happens. So my statement, my payment is due on the 21st. Yep. So I pay it on the 20th because I'm a day early. I'm doing what you said. I got it pre-programmed. But the snapshot is being sent to Equifax and TransUnion on the 15th. So on the day the snapshot is sent, I'm like full up to my maximum limit.
Yeah.
And so they
points.
and they look at my utilization then and say, oh, it's 100%.
That's right.
Even though 5 days later it's going to be zero because I'll have paid it off. That's the issue. So your rule of thumb then is never let your balance anytime go above half. And then obviously pay it off in full at the end of the month. And that's right. Going to maximize your credit score.
You bet. And people really don't understand how essential that is to the scoring system or how a bank and lender looks at that as risk. When you're maxed out, that is as bad as being late on your payments. So that was one of the biggest things that really shocked me when I became a mortgage broker. I would look at these people, they had great payment history, well-established, great accounts, everything was really strong, but then they were maxed out And they, I'd ask them about it. Why are you maxed out when I can see you have great assets, you have great, money in the bank, and you have great employment. So why are you maxed out all the time? Well, we're not, right? Because we pay it off in full every month. And then the light bulb's like, okay, well, you got to change this habit.
Can you tell that when you look at a credit report that the person is like has maximum utilization?
Yeah.
And how does that show up on a credit report?
So the individual accounts will show, and then there's a lot of different views of the credit report, but some of the credit reports will actually show like a global utilization. So it will take all of your revolving credit, like a credit card or a line of credit, and say you're at 75% globally, which means all of your accounts. But then on a credit report, I can see what the limit is and what the balance is on each individual account.
Gotcha. And so it's pretty easy to calculate utilization from that. And again, it's a snapshot as of today.
That's
now, you mentioned the word revolving credit. Explain what revolving credit is. And what's the other thing that isn't revolving credit?
So there's a few main types of account or credit accounts that are important. The revolving just means you can use it and pay it off whenever.
It revolves.
It revolves. So you can pay it off, use it as many times as you want. A loan, you start with a high balance and then you pay it down, hopefully.
That's the plan.
That's the plan, is to pay it off in full. And then the other type of an account is an O type account, which is a cell phone, which just means that there is no limit. So essentially the credit card or the cell phone companies would be happy to continue charging you for that extra data or whatever. There is no limit.
O meaning open?
Yeah.
So this concept of utilization applies to a credit card, but it doesn't apply to a non-revolving type of debt.
And as well, they've made some changes as well to the line of credit. Before, I guess should say about 3 or 4 years ago, home equity lines of credit or unsecured lines of credit were looked at like a credit card. And a lot of people would keep their debt on their lines of credit, secured or unsecured, because it's cheaper, the lowest interest rate. So then Equifax changed and TransUnion made some updates as well, where they realize that. And so now lines of credit act more like loans, where the balance versus the limit really isn't contributing to the score. Yeah,
and we've certainly done lots of shows on that. HELOCs are, for a lot of people, their mortgage.
That's right.
Home equity line of credit. Well, and rather than getting a $300,000 mortgage, why don't I just get a $300,000 line of credit? Then I could pay it off, use it up and down. And so the credit reporting agencies are now recognizing that. Yeah. Okay, so tell me why age matters. You make that point in the credit game. Why does age matter? How does age matter?
Age of how long that account has been established. So a bank or lender would look at you having a credit card as great, and that can affect the score and jump your score very quickly. The problem is that the banks and lenders want to see how you've used that over an extended period of time. Almost anyone can handle a credit card well for a few weeks, a month, maybe a year, but it's when you're sick, job loss, when life happens, can you still manage that good history? And so a bank or lender is really impressed the longer it goes. So 2 years is kind of their ideal, or what they would consider established. However, the longer it's been established or open and well used, the better it is for the less risk you are and the higher your score.
So if I've gone through a hiccup in my life, maybe I had to file a consumer proposal, I'm rebuilding my credit, age matters. So getting a credit card or something soon and building up the history is, tell me if I'm right or not, more important than getting a big credit card. So get something with a $500, $1,000 limit, and then 2 years from now, 3 years from now, 4 years from now, when I'm starting to think about buying a house, that's when I get the limit increased. Is that correct?
That is correct. So a lot of people coming through any kind of debt program sometimes have a really freaked out, don't want to deal with credit cards, because that was one of the reasons why they were in the situation in the beginning. So that's one of the things that I have that conversation with them. Listen, get a low limit and just keep it there, secured or unsecured, but just get a low limit and stick with that, and put the one transaction on or whatever, and then just ride that until you do feel more comfortable, before until you're better established and that you can stay in control. Is
there a difference to my credit score between a secured and an unsecured credit card?
To the score, very little.
So if and for people who are watching, unsecured credit card is what we all think about. It's a credit card. There's nothing attached to it. A secured credit card would be where you say to the credit card company, here you go, I'm giving you $1,000. You hold that in trust in an account somewhere, and they give you a card with $1,000 limit. And that's something very easy to qualify for, even if you're in a bankruptcy or a consumer proposal, because there's no risk to the lender. You've prepaid the money. Yeah. So a secured or an unsecured card on your credit report shows up as a credit card?
That's right.
It doesn't say secured card?
Sometimes it does, and other times it doesn't. It just depends on the institution. But one thing that's really important to clarify is that prepaid cards are not secured cards. So prepaid is you go to the store and you load it. So you put money on it, and then you use that amount, and then if you want any additional money on there, you got to load it up again. Whereas secure credit card, that's where you take $500 or a set amount and you put it as kind of like a damage deposit, and then that is held by the company, and then the credit card that you get is like a regular credit card. If you don't pay it off in full at the end of the month or during the month, then you pay interest on that, and it's just
like a regular
just
credit
like
card.
A regular credit card.
Yeah, a prepaid card conceptually is like a gift card.
Exactly. I could get you a secured or a prepaid credit card, whereas a secured credit card you have to apply yourself in order to get that.
It has to be in my own name,
and it's attached to your name and to your credit report.
And so that's an important clarification. Then going to the cash place and getting a prepaid card, that's fine if you want to, pay your Netflix subscription or something, but it's not going to have any impact on your credit score. Yeah. So secured or unsecured, it depends on how they're reported, but they would both, used wisely, will help improve your credit score. And that's why, well, let's talk about rebuilding then, because, a lot of my clients are in that situation where, okay, some bad stuff happened. I lost my job. I got sick. I got divorced, ended up with some debt. I've now done my proposal and I want to reestablish because someday I do want to finance a car, buy a house, or even just get a better deal when I'm renting a place or a better deal on my car insurance or something. So the steps in rebuilding, like number one, getting out of debt. That's kind of obvious. That's what I'm here. The next step then is, age matters. We talked about that. You also make the comment that you need 2 trade lines.
Yes.
What does that mean?
A lot of people will get one. They'll get a loan or they'll get a credit card.
So a trade line is any kind of debt, really. Credit card, bank loan, line of credit.
Mortgage, those would all be considered. And when I say loans, that includes leases, exact same way. But having one is not good enough, especially when you're trying to reestablish for major financing like a mortgage. Banks and lenders say, great, you handled a credit card, you handled a loan payment, that's great. However, we want to see multiple, because we want to see how well you handle multiple payments, because we're going to give you another one. And now we want to make sure that it's not just, okay, you can handle a $400 payment. We want to make sure that you can handle all your bills correctly.
Yeah, because when we give you that mortgage, that will be another payment by definition. Yeah. So we want to make sure that you've already been able to handle 1 or 2. And is that a CMHC guideline? So when they're looking to decide whether they're doing their approval process or whatever, then that's part of the process.
That's actually right from all the insurers. So CMHC, Genworth, Canada Guarantee. So anytime you put less than 20% down, that's
you have to have mortgage insurance.
Yeah, and they're, even though you're going through a TD or an RBC, whatever bank you're going through, the decision lies with CMHC, Genworth, Canada Guarantee. So that's their guidelines. 2 trade lines, at least 2 years, and preferably with limits of $2,500 or more.
So 2 years, 2 trade lines, $2,500 or more. So if you're shooting for 3,000 on each, then you've got a much better much better shot at it.
Yeah, you don't have to go crazy with the limits, but that 3,000, 2,500 mark is
you don't need 10,000. You don't need 50,000.
Yeah.
Now, you made the comment in your book, second bankruptcy is the kiss of death. Tell me why you said that.
It's terrible to see, because with a bankruptcy, it's on your credit report for 6 years, and
that's 6 years after your discharge.
That's right.
So if the bankruptcy lasts for 9 months, 6 years plus 9 months. If it lasts for 2 years, 3 years, depending on your situation, could be 6 years, 7 years, 8 years, whatever. Okay,
that's right.
That's a first bankruptcy.
That's a first bankruptcy, and a proposal. Another popular option is 3 years from completion. What really sucks is when they go into a second bankruptcy, and now it stays on. Both insolvencies or bankruptcies will come back with a 14-year record from completion, which is is quite a jump, right? It's it's not 6 plus 6, or it jumps to 14. And when a bank or lender sees a double bankruptcy, even if you have a great credit score, they're going to most likely decline you automatically. So unless you have serious assets, really good income, or something that is really impressive, you're not going to get best rate financing going forward with a mortgage or major financing.
Yeah, it's a 14-year penalty, and I guess their rationale is, well, stuff happens. Lots of people end up getting into financial trouble, but in this case, stuff happened twice.
Yeah.
So that's
kind of a trend. Yeah.
That's where the double penalty comes in. So what would your advice be then for someone in that situation? Are you better off doing a consumer proposal as the second insolvency as opposed to a second bankruptcy?
I mean, it always depends on the situation, but generally speaking, if there's any way that you can get into a different debt program as opposed to going into a bankruptcy a second time, then that's something to really consider.
And just to be specific about what you said, a consumer proposal stays on your credit report. And again, correct me if I'm wrong, because I believe this changed in 2019. 3 years from the date of completion.
That's correct.
Or a maximum of 6 years. That's what I believe Equifax and TransUnion are both saying now.
So yeah, they're saying that, but generally speaking, with TransUnion, they like to keep it on for 7 years. So you might still see that 1 year longer, but
so 6 or 7 years,
yeah,
right?
That's right.
Okay, that's an important clarification. So, but compared to 14 years in a bankruptcy, and that's 14 years from discharge,
right? And a second bankruptcy is a minimum.
It's minimum of 2 years.
That's right.
Yeah, if you have no surplus income, it's 2 years. If you have surplus income, it's 3 years. So if you have surplus income and do a second bankruptcy, that's 17 years on your credit report.
Yeah.
And as you said, it doesn't mean you can't borrow.
Yeah.
It just means that there is a much higher hurdle. You're going to need a much bigger security deposit, down payment, co-sign, or you're going to pay a higher interest rate, whatever.
That's right.
And that's why when someone comes in here who's been through a bankruptcy, even if it was 30 years ago, it isn't showing up on their credit report anymore, but it comes back. As you said, it's still in the computer. So those are the people I say, well, is there any way you can pay this off on your own? Yes. Like anything you can possibly do. Right. If not, okay, let's talk about the proposal option then. I mean, you could do a debt management plan, but then you're paying 100 cents on the dollar. If you could pay 100 cents on the dollar, you're probably not coming in to see me. So that's when we get into the discussion of a consumer proposal. And a consumer proposal, if you were bankrupt at some point in the past, is probably going to cost more than if you were never bankrupt before, because the creditors are going to say, well, wait a minute, we know you want to avoid the second bankruptcy. Yeah. So it's a pricier thing. But 6 years... maybe 7 years versus 14 from a credit score point of view, it's a no-brainer.
That's right. Yeah.
Okay, so let's wrap up here with however you want to end it. And I want to be very clear about what you and I are talking about today. We are not saying go out and borrow as much money as you can. Here, we're going to show you how to maximize all your debt. That's not the point here. And you're very clear in your book that your advice is pay everything off every month. I mean, not your mortgage, but, credit cards, any kind of revolving loans, pay it off every month. End of story, boom, like you're very unequivocal about that. And I totally agree. Yeah. We're not here to show you how to game the system.
That's right.
it's the reverse. The system is a game. It's the credit game. And so, well, if you're going to be in that arena, you might as well understand it. And credit is something that ultimately, for many people, is necessary. You can't buy a house unless you have credit, unless you're rich, like super rich. Financing a car. Okay, I guess we could all buy used cars, but if I, live in Markham and work at the east end of Scarborough and I got to drive my kid to this place, okay, I need a car. Well, a reliable car, if I can finance it, I can potentially get a better car. So even renting an apartment, getting a job, there are lots of jobs that will check your credit. So we're not giving this advice so that you can get as much debt as you possibly can.
That's right.
We're giving you this advice because this is the world we live in. You might as well understand how it works.
Exactly.
Am I correct? Is there any bad advice you want to end the show with? Is there? I mean, we've touched on a few things that don't do that, don't do that. Is there any other bad advice you want to end the show with, or do you want to just wrap up with your closing comments on what you should be doing?
No, I think it's good. The biggest thing that is a 180 from everything else that's being kind of preached out there, or this obsession with the credit score. Checking your credit, awesome. Great idea. Keep on top of things. Definitely suggest that that's a good idea, just to make sure that there's no fraud. Even if you don't have credit or you're not a big fan of credit, it's still good, because if you're not using your credit, someone else might be. So it's good just to know what's going on there. However, this obsession about your score is way blown out of proportion. And I mean, I check my report often, but I never worry about the score, because it's always there when I need it, and I don't care whether it's 715 or 815. So trying to get this really high score compared to everyone else in Canada or whatever the game is, I think that's just, it will drive you mad, because it's always going to go up and down, and that's not even the score that the banks are going to use anyways. So I just want to clarify that checking the report, great idea. Obsessing about the score, just learn how the game is played. It's simple once you understand it, and then just live your life with things that are way more important than the score.
Yeah, money in the bank, I think, is way more important.
I was going to say family and friends.
Okay, you're right. I think you're absolutely right there. Yeah, look at the big picture here. Yeah. Those are just from a guy with 5 kids. So, I mean, obviously he's going to be pro-family here.
Yeah, my wife might listen.
That's right, just in case. Hi. It reminds me of somebody who weighs themselves on the scale 5 times a day. Well, your weight's going to fluctuate day to day, week to week. Okay, so I guess keeping an eye on it isn't a bad thing, but making that your sole obsession is probably a crazy idea.
Be healthy, not obsess about the skinny, or because that can lead to a lot of obsession about stuff that really doesn't matter in the end.
Well, can you do a push-up? Maybe that's more important than what your weight is. Can you walk for a kilometer or not? Like, there's a whole bunch of other metrics, and I think you're exactly right. The credit score becomes a sole focus, and it's misplaced. There's a lot of other things that we should be watching out for. So once again, Richard Moxley, The Credit Game. What's the website people can find out more at?
Creditgame.net.
And is that the best way to track you down? Is there
for any kind of information? However, if you're looking for the verbal, I can't even think, the online book or the audio book, then you can just go to the iTunes or the Amazon.
So it's available. So there's a Kindle version,
the Kindle and audio,
and the Kindle and audio. So there you go. Go to Amazon, and you can have it on your Kindle 3 minutes after the show ends. And a lot of good practical advice. It's it's an easy read. You've got all the technical terms in there, but it's not full of jargon. I think anyone can understand it. So if you want to understand the credit game, there you go. Richard Moxley, thanks very much for being here.
Thanks, Doug.
That's Richard Moxley, The Credit Game, and that is our show for today. Thanks for listening. Until next week, I'm Doug Hoyes. That was Debt Free in 30. Do you want to throw a credit card at the thing? So you can just see, it's a lot harder to do than try. You pick anything, it's hard to do. So there we go. Excellent.
Done and done.